Welcome to the Deep Dive.
Hey there.
Today we're doing what we do best, taking a single source, really digging into it.
Yeah, finding those important nuggets for you.
Our source today, it's the recent fiscal 2025 first quarter earnings call transcript for the retailer, Tillys.
That's right. We've gone through the call, and we're here to pull out the key insights, the trends, the numbers, basically everything management talked about.
All to understand how the company's doing and, what they see coming down the pike.
Exactly. Performance and outlook.
Okay, let's unpack this earnings call then. Tillys, they sell clothes, shoes, accessories, mainly to a younger crowd, right? Teens, young adults.
Yeah, young men, young women, boys, girls. Mostly in malls, shopping centers across, 33 states?
Yeah.
And online too, of course.
Right. And they just reported Q1 fiscal 2025. That's the period ending May 4th, 2024. So what's the big picture, the high-level summary?
Well, looking at the top line first, net sales actually came in within the range they'd guided to previously.
Okay, so they hit their own target there. What was the number?
Around $107.1 million for the quarter.
But compared to last year?
Yeah, that's where you see the change. Total net sales were down 7.1% compared to Q1 last year.
And comparable sales, the like-for-like store and online sales?
Also down, comps decreased by 7%.
Which I imagine didn't help the bottom line.
No, definitely not. It resulted in a net loss for the quarter. And it was pretty significant, actually, $22.2 million.
Wow. And per share?
It works out to a loss of 74 cents per share.
So, okay, headline numbers, sales down, decent size loss. But you said there's more context here.
Yeah, I think what's really fascinating isn't just those numbers, but the story within the quarter, particularly around the sales trends. How things change month by month and what that might signal.
Right, because that 7% comp decrease for the whole quarter, management pointed out it was actually better than the previous quarter, Q4.
Exactly. That's the key point they kept hitting. Q1 comps were down 7%, sure, but Q4 comps were down 11.2%. So that's a noticeable sequential improvement.
Okay, nearly cut the decline rate in half, quarter over quarter. Did they break down Q1?
They did. February started off down 5.7%. Then March was rough, down 13.8%.
Ouch.
But then April flipped positive, actually up 1.5%.
Whoa, okay. From down almost 14% to up 1.5%. That's quite a swing.
It really is. And it wasn't just like a fluke at the end of the quarter either. They said that improvement continued right into the start of Q2, so fiscal May.
How did May look?
Comp sales in May were down just 2.2%.
Okay, so still down, but way better than the Q1 average of negative 7%, and certainly better than that March number.
Right, so you see this pattern, negative 11.2% in Q4, then negative 7% average in Q1, but with that positive April, and then May narrowing the gap further to negative 2.2%.
So management's take on this, what are they saying this trend means?
They're suggesting it's a strong sign that their merchandise assortment is, getting better. It's starting to click with customers again.
They think the business might be stabilizing.
That's the cautious optimism, yeah. Signs of potential stabilization after a really tough stretch.
Did they give any color on what drove the sales number? Like traffic versus how much people spent?
Yeah, a little bit. For Q1 overall, traffic, so store visits or website visits, was down low single digits.
Okay.
And the average sale, how much each customer spent per transaction, also down low single digits in Q1.
So fewer people and they spent slightly less, leading to that 7% decline. Makes sense.
Yeah.
What about May, though, with that much better negative 2.2% number?
This is where it gets interesting, like you said. Traffic in May was still down low single digits, pretty similar to Q1.
Still struggling to get people in the door, basically.
Kind of, but the average sale, that actually flipped positive in May. It was up 1% compared to last May.
Okay. So even though traffic was still weak, the people who did shop spent more on average.
Exactly. Which could mean a few things, right? Maybe they're finding more items they like because the assortment is better, like management thinks. Or maybe they're just buying higher price things.
Or a mix of both.
Probably. But that positive average sale, even with negative traffic, it does seem to lend some support to their idea that the merchandise is performing better. It's helping to offset that traffic
But
weakness.
still need the traffic, obviously, but it's a step.
It's definitely a component you need to see turning around.
Okay, so improving sales trend, at least sequentially. How did this flow through to the rest of the financials? Let's talk margins, gross margin.
Gross margin for Q1 was 19.8% of net sales. That's down from 21% in the same quarter last year.
So lower margin overall, what caused that drop? Was it product costs?
Actually, no. Product margins themselves improved slightly. by 40 basis points or 0.4%.
How?
They said it was mainly due to higher initial markups, so pricing things a bit higher to start, although that was partially offset because they had to take some higher inventory valuation reserves.
Okay, so if product margin was up slightly, why was the overall gross margin down?
It was the other stuff in gross margin. Buying, distribution, and occupancy costs, rent, basically.
Right.
Those costs deleveraged by 160 basis points.
Deleveraged, meaning the dollar amount might have been flat or even down, but sales fell faster.
Exactly. Those costs became a bigger percentage of a smaller sales number.
Yeah.
Like your store rent stays the same. But if sales drop, rent eats up a bigger chunk of your revenue.
Got it. Okay, what about operating expenses? SG&A, selling, general, and admin.
SG&A dollars actually came down year over year. It was $44 million this Q1 versus $45.1 million last year. So down about $1.1 million.
That's good. Where did they find savings?
Mostly from store payroll and benefits. That was down $9 million. And they also had lower charges for non-cash asset write-offs, down $500,000.
But didn't they say they spent more on something?
Yes, marketing. Marketing expenses were actually up by $7 million compared to last year.
Interesting. So cutting some costs, but investing more in marketing. Did SG&A still deleverage overall, though, because of the sales drop?
It did, yeah. Even with the dollar savings, SG&A deleveraged by 190 basis points against those lower sales. Same reason as occupancy, it became a higher percentage of the smaller sales pie.
Okay. So lower sales, pressure on gross margin from fixed costs, SG&A deleveraging despite some cuts. That all leads back to that loss.
Right. The pre-tax loss was $22.3 million, which is 20.7% of their sales. And the net loss after taxes was $22.2 million, or 74 cents a share.
And you mentioned something about taxes impacting that number, a valuation allowance.
Yeah, a non-cash deferred tax asset valuation allowance. Basically, companies can sometimes use past losses to offset future taxes. That's a deferred tax asset.
Okay.
But if the company thinks it's unlikely they'll actually have enough future profit to use those potential savings, they have to record an allowance, essentially writing down the value of that asset.
So it's an accounting charge that reflects pessimism about future profitability.
Pretty much. It means they couldn't get a tax benefit this quarter from their losses, which makes the reported net loss look worse than it might otherwise. It's technical, but it impacts the bottom line number you see.
So connecting this back, they're trimming costs like payroll where they can, but deliberately spending more on marketing even while sales are down. That's quite a balancing act.
It really is. They're trying to manage through this tough spot. Fixed costs like rent are hurting them as sales drop. That's the deleveraging. So they cut what they can, but they seem to believe investing in marketing is critical right now to, turn things around.
Makes sense. Spend money to make money, potentially.
But it puts a lot of pressure on those marketing efforts to actually work and drive sales up so they can get leverage back on those fixed costs.
One definite bright spot they highlighted was the balance sheet, still debt-free.
Yeah, that's huge. Gives them a lot more breathing room. They ended Q1 with $92.6 million in total liquidity.
And what's that made up of?
About $37.2 million in actual cash and marketable securities, plus another $55.4 million available to borrow under their asset-backed credit line.
Which is basically a loan secured by their assets, like inventory.
Right. And they just extended that credit line out to June 2027, so they've secured that access to potential funding for a while longer.
Good move. How's inventory looking, given sales were down? Are they stuck with too much stuff?
Seems like they're managing it okay. Total inventory value on the balance sheet was down 3.8% year over year, and the actual number of units was down even more, almost 11%, 10.9% down.
So fewer items on hand, which sounds appropriate if sales are lower.
Yeah, it suggests they're aligning stock levels with demand. You don't want to be sitting on piles of unsold goods when sales are tough.
What about their stores, the physical footprint?
They finished Q1 with 238 stores. That's a net drop of 8 stores from a year ago.
Are more changes coming there? Store closures?
Looks like it. They expect to end Q2 with 232 stores. So they closed 7 and opened 1 during Q2.
Okay. Net decrease of 6 in Q2. What about after that?
They flagged 2 more closures planned for Q3, and then potentially up to 15 additional closures by the end of the fiscal year.
Wow, up to 15 more.
Yeah, but that depends on lease negotiations. As leases come up for renewal, they'll decide whether to keep those stores open or not.
Which, again, ties back to those occupancy costs. Closing underperforming stores should help ease that deleveraging pressure over time, right?
Absolutely. It's a necessary part of optimizing the cost structure when sales are challenged.
Okay, moving away from the pure financials, management really seemed to emphasize their marketing and customer engagement efforts. They think that's a big reason for the improving sales trend.
Yeah, they spent a fair bit of time on this. They've been pretty active trying to, build brand awareness and connect with their customers.
What kind of things are they doing?
A lot digitally. They launched a Tillys TikTok shop back in early March.
TikTok shop, interesting. How's that going?
Apparently pretty well. They said by mid-April, it actually started doing more daily order volume than their Amazon presence. And it's still growing.
That is interesting. Shows where their audience is, I guess.
Definitely suggests TikTok is a key channel for them. They've also been doing a lot of events, trying to tie into youth culture.
Like what?
They had a launch party in West Hollywood with influencers and celebs. They were part of a big festival season event out in Palm Springs, surfing, DJs, that kind of thing. Said it drew over 10,000 people.
Okay, trying to be where the kids are. Any others? They mentioned some surprising names.
Yeah. They had Mike Tyson do an appearance at a Las Vegas store.
Mike Tyson? Okay.
And a Travis Barker product collaboration event with Hurley down in Irvine.
Right, Travis Barker makes a bit more sense maybe with the skate and music connection, but Tyson.
Yeah, it's eclectic. But management's point is that all these things, the TikTok shop, the influencer parties, the festivals, even the slightly random celeb appearances, are about cementing Tillys' position as authentically part of youth culture, fashion, and music.
The idea being that builds brand affinity, makes kids like the brand more.
That's the theory. Build that connection, that cool factor, and hopefully that translates into better business results, more traffic, more sales.
It's fascinating to see them try these maybe more targeted cultural plays instead of just, generic ads. But how do you measure if a Mike Tyson appearance actually sells more t-shirts,
That's the million-dollar question, isn't it? It's hard to directly track the ROI on some of these things compared to, say, a digital ad click. But they seem convinced it's contributing to that improved sales momentum they're seeing. They're placing bets on these cultural touch points.
Okay, makes sense. Let's shift to looking forward then. What did they say about the next quarter, Q2? That's the one ending in early August.
Right, so they gave guidance for Q2 based on those May trends we talked about and their usual historical patterns for the quarter.
What's the sales outlook?
They're estimating net sales between $150 million and $158 million.
And the comparable sales number, that's the key one.
Their forecast for Q2 comps is a decrease of 5% to flat. So 0% change at the high end.
Okay, that high-end flat comps would be a huge step up from Q1's -7%. That's quite a range, -5% to 0%.
It is. It reflects, I think, both the improvement they've seen, but also the uncertainty, especially around the back-to-school season, which falls heavily in Q2.
Did they guide on expenses for Q2 SG&A?
Yep. Estimate is around $48 million to $49 million for SG&A in Q2. And they noted that excludes any potential non-cash impairment charges.
And taxes, still that weird near zero rate.
Yeah, because of that valuation allowance, they expect a near zero effective tax rate again for Q2.
So putting that all together, sales between 150 M and 158 shams, comps between -5% and 0%, SG&A 48 shams to $49. What's the bottom line projection?
Again, it's a range reflecting that sales uncertainty. They're projecting anywhere from a net loss of about $2.7 million to potential net income of $2 million.
So possibly back in the black for Q2 if things go well.
If they hit the higher end of that guidance, yes. On a per share basis, that's a loss of 9 cents to potential earnings of 7 cents.
And liquidity, how do they see cash holding up?
They expect total liquidity to actually increase by the end of Q2, landing somewhere between $106 million and $111 million.
Which makes sense. Q2 has higher sales volume than Q1.
Right. And they made a really important point about why Q2 sales are higher and why they have that, cautious optimism about hitting the high end of their guidance, maybe even getting to flat comps.
What was the point?
It's about the timing within the quarter. May, which had that improved net 2.2% comp, is usually only about 25% of Q2's total sales.
Only a quarter, so most of the sales happen later.
Yeah, the biggest sales weeks for them in Q2 are typically the last 2 or 3 weeks of the quarter.
Why then?
Back to school. That's the start of the big back-to-school shopping season.
Ah, of course.
And management specifically said back-to-school has been their strongest season in recent years.
So the combination of the improving trend they already saw in May, plus the fact that the bulk of Q2 sales happened during their historically strongest period, that gives them hope.
Exactly. It gives them that cautious optimism that they could potentially get comps close to flat, maybe even slightly positive if back to school performs well for them again. It's critical.
Makes sense. Okay, what about the merchandise itself? They seem positive there too.
Yeah, the phrase they used was it's looking better, selling better.
And they're proof.
Well, again, they pointed to the improving traffic trend that's been up now in the last several weeks, or at least less negative, and just the overall sales trend closing that gap.
Any specific product areas doing well?
They called out the junior side, so apparel for young women and girls, saying it's becoming really spot on.
Okay.
They also said men's has always done a decent job, but the overall message was that the improvement feels like it's happening across the board.
Which ties back to that average sale turning positive in May, maybe. If the whole assortment is better, people find more to buy.
Could be. Seems plausible.
Yeah.
One last thing on the product front, tariffs. Any worries there?
Always a potential headache for retailers. What did they say?
They acknowledged it's a concern, the potential impact. But based on what they know now, the impacts seem relatively minor for them.
Are they doing anything about it?
Yeah, they said they're working with their sourcing partners, their suppliers, to try and mitigate any potential cost increases from tariffs.
So overall outlook on product margins for the rest of the year.
They expect product margins to be pretty consistent with last year, maybe even slightly better. They aren't currently forecasting a big hit from tariffs, though they did caution the situation is, volatile.
Okay. And just quickly, anything else noteworthy pop out from the Q&A session at the end of the call?
Not really anything groundbreaking. It mostly just reinforced the points they had already made in their prepared remarks.
Like confirming the monthly sales numbers?
Yeah, confirming that Q1 cadence, February now 5.7, March 13.8, April plus 1.5. And clarifying again the transaction versus average sale trends, especially that positive average sale in May.
Anything else?
Someone asked if they had been talking to activist investors or had any board seat requests. Management's answer was a simple no. And they elaborated a bit more on that deleveraging of buying, distribution, and occupancy costs.
Yeah.
Basically saying that while store closures help lower the dollar amount, the only way to really get leverage back on that line is to get comparable sales growing again, flat or positive.
Right. Need the sales recovery. Okay, so let's try and synthesize this. We've dug deep into this one earnings call. What does it all mean for you listening? Why should you care about, Tillys Q1 results?
Well, maybe it gives you a specific real-world example of what's happening in youth retail right now. You see the challenges, the sales declines.
But also the strategies they're using to fight back, like leaning into TikTok, these cultural events, trying to find that connection.
Exactly. And it highlights the financial juggling act, right? Managing costs, dealing with things like rent deleverage, while still trying to invest in growth areas like marketing.
And balancing that with maintaining a strong balance sheet, which Tillys seems to be doing with no debt.
So, thinking about everything we discussed, what stands out most to you? Is it that sequential sales improvement? Does that feel like a real turnaround starting?
Or maybe it's those specific marketing tactics. Do you think the TikTok shop and the influencer events are the right way to reach that audience?
Or perhaps it's just the fact that despite the losses, they still have that debt-free balance sheet and decent liquidity. Does that give them enough runway? Lots to consider.
So let's quickly recap the key takeaways from this deep dive. The big story is that sequential improvement in sales trends, month by month. Things got less bad, culminating in that positive April and near flat May.
Right. And management believes this is driven, at least in part, by improvements in their merchandise assortment and those targeted marketing efforts we talked about.
Meanwhile, they are managing costs where they can, but still facing pressure from things like rent on lower sales. But they do have that solid balance sheet, debt-free, providing some cushion.
And remember, everything we've discussed today comes directly from that one source. The Tillys fiscal Q1 2025 earnings call transcript. We're just breaking down what the company shared.
Exactly. And as always, this is purely for educational and informational purposes. It's based on the source material provided to us. It is definitely not financial advice. Please don't take it as such.
So here's a final thought for you to chew on, building on what we heard in the call. Management stressed how incredibly important that back-to-school season is for them. It happens mostly at the end of Q2. And it's historically their strongest period.
Right. It's key to them hitting that Q2 guidance, especially the high end.
So the question is, how much weight should you really put on the improving trend they saw in May versus what happens in those crucial last few weeks of July during back to school? Is a strong back to school enough to say, okay, they've turned a corner? Or could it just be a temporary seasonal boost?
Something to think about as we see how the next quarter actually unfolds for them.